$6 trillion gone, evaporated into thin air in less than 60 minutes. If you bought silver at $121 or gold at $5,600, you are hurting right now. You are staring at a screen of red. But listen closely. This was not bad luck. This was not a glitch. This was a robbery in broad daylight. Right now, most people are panicking. They see the price dropping and they think the bull market is over. They think the run is finished. They are wrong. What you just witnessed wasn't a death spiral. It was a trap. A specifically designed bear trap set by the biggest players on the planet. And unfortunately, most retail investors walked right into it. If you don't understand why gold just dropped $500 in an hour, you're going to get slaughtered. You will panic sell at the bottom right before the market rips higher. But if you do understand what just happened, this isn't a disaster. It is the buying opportunity of a lifetime. I'm going to show you exactly why this crash happened. I'm going to explain the hidden mechanism that pulls the strings of the global economy. And I'm going to share a specific date, a time window that tells us exactly when this bleeding stops and the rocket takes off. But you need to understand the crash first. Let's look at the crime scene. It's January 29th, 2026. 1 minute, everything looks perfect. Gold is at an all-time high. Silver is flying. The charts look unstoppable. Investors are feeling invincible. Then someone flipped a switch. In the time it takes you to watch a single episode of a sitcom, fortunes were wiped out. Gold plummeted from $5,600 to $5,100. That is a $500 drop. Silver crashed from $121 to $108. That is $13 off the price. Think about that. If you had $100,000 invested in silver at the peak, $11,000 vanished while you were making a cup of coffee. That money didn't just disappear. It transferred. It moved from your pocket to someone else's. Here's how it works. It's called a liquidation cascade. That sounds fancy, but it is actually very simple. Imagine a row of dominoes. When the price drops a little bit, the traders who borrowed money to buy, the leverage traders, get a call from their broker. It's a margin call. The broker says, put up more cash or we sell your position. Most people don't have the cash, so the broker sells. That selling drives the price down further. That hits the next group of dominoes. More brokers sell more positions. The price drops again. It hits the next group faster and faster. Selling triggers selling. It becomes a waterfall, a landslide of red candles. So, while you were refreshing your screen, wondering what broke, nothing actually broke. The system was working exactly as it was designed to. It was hunting. It was hunting for overconfident people. It was hunting for stop losses. The mainstream news will tell you this is just market volatility. They will say it is normal noise. They are lying to you. They are reading from a script. Crashes this specific, this fast, and this violent are never accidents. The big institutions, the banks, the hedge funds, the guys with the algorithms, they knew this was coming. In fact, they needed this to happen. They saw the signals days ago. While you were buying the breakout, they were loading the trap. They were positioning themselves to scoop up your panic selling. They sell high to you, crash the price, and then buy it back from you for pennies. That is the game. But here's the good news. I have seen this movie before. I know how it ends. Think back to just a few weeks ago, late December 2025, the last 2 days of the year. We saw the same pattern, the same crash, the same panic. Everyone screamed that the market was dead. And what happened the very next week? January exploded. Gold rallied by 30%. Silver went up 65%. It was the biggest rally in decades. History doesn't repeat itself perfectly, but it rhymes. This crash looks terrifying, but it might actually be the fuel for the next leg up. So why did it happen? Why today? Why this hour? It wasn't because of a mine shut down. It wasn't because people suddenly hate gold. The metal didn't change. The price tag changed. And the price tag changed because of one invisible force that 90% of investors ignore. It is called the DXY. If you don't know what the DXY is, you are trading with a blindfold on. DXY stands for the dollar index. Think of it like a report card for the US dollar. It compares the dollar to a basket of other currencies like the euro, the yen, and the pound. Here's the simple rule you need to tattoo on your brain. The dollar and gold are on a seesaw. When the dollar gets heavy and goes up, gold goes down. When the dollar gets weak and goes down, gold goes up. They are enemies. They fight for the same space. So gold didn't really crash. The dollar spiked. The floor you were standing on suddenly shot upward, which made everything else look like it was falling. To understand the gold market, you have to stop looking at gold. You have to look at the dollar. This is the secret mechanic. This is the engine under the hood. Gold and silver are locked in a cage match with the dollar. They are enemies. They are rivals. And here's the rule you cannot break. They move in opposite directions. This isn't a sometimes rule. This isn't a maybe rule. This is a law of gravity in the financial world. Let me break this down so a fifth grader could trade it. Gold and silver are priced in US dollars. That means the price tag is in dollars. When the dollar gets strong, it becomes more valuable. It has more muscle. So, it takes fewer of these strong dollars to buy an ounce of gold. The price on the tag goes down. But when the dollar gets weak, it loses muscle. It becomes flimsy. You need a big pile of weak dollars to buy that same ounce of gold. The price on the tag goes up. Picture a seesaw on a playground. It's the perfect analogy. On the left seat, you have the US dollar. On the right seat, you have gold and silver. If the dollar fat cat sits down heavily on the left, the gold side flies up into the air. But if the dollar jumps off and the left side crashes down, gold rockets to the moon. They cannot both be up at the same time. The seesaw doesn't work that way. Physics doesn't work that way. And this brings us to the biggest mistake retail investors make. The mistake that is costing you thousands of dollars. You are staring at the gold chart. You are obsessed with the silver chart. You are looking at the lines, drawing triangles, hoping for a breakout. But the professional traders, the guys on Wall Street with the multi-million-dollar bonuses, they aren't even looking at the gold chart. They are staring at the dollar. They are watching the DXY. Because the DXY is the crystal ball. It tells you what gold is going to do before gold actually does it. So today, when the crash happened, it wasn't a mystery. The DXY pumped. The dollar flexed its muscles against the euro, the yen, and the pound. The dollar side of the seesaw slammed down, and naturally the metal side got launched into the dirt. It's not a conspiracy against you. It's not manipulation. It's just mechanics. But because you were watching the wrong chart, you were blind. You were the last person to know. The hedge funds saw the dollar spike. They sold their gold immediately. They got out at the top. 5 minutes later, you saw the red candle on your screen. You panicked. You sold at the bottom. You became their exit liquidity. You bought the bags they were dumping. If you want to stop losing money, you have to stop watching the metal and start watching the currency. When the dollar spikes, run for cover. When the dollar tanks, back up the truck and buy. Now, you are probably asking the million-dollar question. Why did the dollar spike today? What caused the sudden surge that wrecked the metals market? There are 3 specific triggers, 3 hidden levers that were pulled today. I'm going to walk you through all of them. And listen carefully, because the third reason is a ticking time bomb for silver specifically. If you hold silver, reason number 3 is going to keep you up at night. But let's start with reason number 1. The Federal Reserve, the Fed, controls the money printer. And right now the Fed is sending what we call hawkish signals. Let's simplify that word. Hawkish means they want to keep interest rates high. They are acting like a hawk, aggressive and tight. Dovish means they want to be nice and cut rates. Right now the Fed is in full hawk mode. They are terrified of inflation coming back. So they are keeping interest rates high. Why does this matter for the dollar? Because money goes where it is treated best. When US interest rates are high, you get paid more just to hold dollars. You get a fat yield on treasury bonds. It's like a savings account with a massive payout. So investors all over the world, in Europe and Japan and Canada, they look at their own crappy interest rates and they get jealous. They sell their euros, they sell their yen, and they buy US dollars to get that high interest rate. This creates a stampede. Everyone wants dollars. Demand goes up, the price of the dollar goes up, the DXY skyrockets. And as we just learned, when the DXY skyrockets, gold gets crushed. Everyone thought the Fed was going to cut rates this year. They thought the free money party was coming back. The Fed just said no. The market didn't like that. The market realized rates are staying higher for longer. That makes the dollar king, and it makes gold a peasant. That is reason number 1. The Fed lied, and the dollar died. But reason number 2 is completely different. This one isn't about banks. It's about factories. And if you own silver, this is where you need to pay attention. Reason number 2 is China. We are seeing data coming out of China that is ugly. Their economy is slowing down. Their factories are turning off the lights. Manufacturing is shrinking. Why does a factory in China matter for the silver coins in your safe? Because silver isn't just money. It's an ingredient. It is an industrial metal. Over 50% of all the silver mined on Earth doesn't go into coins or bars. It goes into the industry. It goes into solar panels. It goes into iPhones. It goes into electric cars. Every single solar panel on a roof needs silver. Every switch, every chip, almost every piece of modern tech has a little bit of silver inside it. China is the factory of the world. They built the solar panels. They build the electronics. When China is busy, they buy massive amounts of silver to build stuff. The price goes up. But when China slows down, when will the factories stop? They stop buying the ingredient. Demand falls off a cliff. So today we got bad data from China. The factories are stalling. The market panicked. They realized that if China sneezes, silver catches a cold. And today silver got pneumonia. Think about the device you are watching this on right now. Your phone, your laptop. It has silver inside it. Think about the electric car parked down the street. It uses more silver than a gas car. Think about the massive data centers running AI. They are hungry for silver. This metal is the blood of the modern economy. And the heart that pumps that blood is China. China is the factory of the world. They manufacture the solar panels. They build the chips. When the factory floor in China goes quiet, the demand for silver disappears. Traders know this. They see the factory data slow down, and they start imagining the worst. They think nobody is going to buy silver this month. So they sell. And because silver is so reliant on these factories, it gets hit much harder than gold. Gold is money. Silver is money and a machine part. When the machine breaks, silver crashes. That is why silver dropped 11% while gold only dropped 9%. The bad news out of China was a direct hit on silver. That was reason number 2. But I told you there were 3 reasons. And this third reason is the one that gave everyone an excuse to run for the exits. Reason number 3 is happening. Right now in Washington, D.C., the U.S. government is staring down the barrel of a shutdown January 31st. That is 2 days from now. If Congress doesn't sign the check, the government's lights go off. Now we have seen shutdowns before. Usually they are just political theater. They yell at each other. The market gets nervous and then they sign a deal at the last second. But here's the problem. Markets hate uncertainty. They hate not knowing. When investors don't know what is going to happen, they stop taking risks. If they go to the cash, they sell first and ask questions later. And you have to remember the context. We just had a massive rally. Gold was up 30%. Silver was up 65%. People were sitting on mountains of profit. They were looking for a reason to cash out. They were looking for an excuse to click the sell button and lock in that money. The government shutdown was that excuse. It wasn't the main cause, but it was the trigger. It was the snowflake that started the avalanche. So, you have the Fed talking tough on interest rates. You have China's engines stalling out. And you have political chaos in Washington. One of these things is bad. All 3 of them happening on the same morning. That is a perfect storm. That is how you vaporize $6 trillion in an hour. But if you want to survive this market, you need to understand the relationship between the 2 metals. Most people think gold and silver are twins. They think they move together at the same speed, holding hands. That is dangerously wrong. They are not twins. Think of it like this. Gold is a steady cruise ship. Silver is a speedboat with a Ferrari engine. Yes, they usually head in the same direction, but they do not move at the same speed. Silver is gold on steroids. It is the high-octane version. When gold moves 5%, silver moves 10 or 12%. It is amplified. If gold goes up 10%, silver might fly up 20%. That is amazing on the way up. It makes you rich fast. But gravity works both ways. When gold crashes 8%, silver will crash 15 or 20%. Look at the scoreboard today. Gold fell 9%. A huge move. But silver, it fell by almost 11%. That isn't a coincidence. That is the silver multiplier. This is the price of admission for trading silver. It will give you the biggest gains of your life. But if you aren't careful, it will wipe you out twice as fast as gold. The leverage cuts both ways. This brings me to a detail that almost everyone missed today, and it proves my point about the dollar. Look at last Monday. Just a few days ago, we had another crash, but that crash was weird. On Monday, silver collapsed by 14%. It got destroyed. But gold barely moved. It only dropped 2%. Why? Because Monday was about the factories. It was silver-specific news. It was about industrial demand. Gold didn't care about factories, so gold didn't crash. But today was different. Today, both of them fell off a cliff together. Gold is down big. Silver down big. When they both die at the same time, you know the killer wasn't industrial news. The killer was macro. The killer was the dollar. The DXY spiked, and it suffocated both metals instantly. If you want to predict the next crash, stop looking at the metal. Watch the currency. Watch the DXY. When that line spikes, prepare for pain. But here's where things get really strange. I am looking at these charts, and I have a sense of déjà vu. I have seen this exact pattern before. I don't mean 5 years ago. I mean 5 weeks ago. Think back to December 2025. The last 2 days of the year, December 30th and 31st. We saw the same setup. A sharp, violent crash out of nowhere. Panic selling. Liquidations are cascading through the system like a domino effect. The sentiment was awful. Twitter was full of people screaming that the bull run was dead. They said the top was in. And they said, sell everything. Fear was at a maximum. And do you remember what happened the very next week? January started, and the market didn't die. It exploded. Look at the calendar. It's January 29th. We are exactly 2 days away from the end of the month. Does that ring a bell? We just saw a sharp crash. Panic selling, liquidations cascading through the system like a waterfall. We have the same pattern, the same timing, the same fear. And the big question hanging over everyone's head is this. Will February repeat January? Are we about to see another mega pump that leaves the skeptics in the dust? I think we might. And I'm going to tell you why. First, you have to understand what didn't change today. This is critical. The crash was about the dollar. It was about the federal. It was about nervous traders with paper hands getting shaken out of the tree. But the fundamentals, the bedrock reality of the market, that didn't change one bit. While you were panicking and checking your account balance, Tether was still buying 1 to 2 tons of gold. They do it every single week. Do you think they stopped because of a 60-minute drop? No, they don't care about your fear. They are accumulating. While you were staring at red candles, the BRICS nations, China, Russia, India, they were still stacking bars in their vaults. They didn't sell today. They bought. They treat crashes like a Black Friday sale. They have been doing this for years, and they aren't stopping now. The de-dollarization trend. Countries moving away from the US dollar that didn't reverse in 60 minutes. The massive shortage of silver, 5 years of running out of silver, that didn't magically get fixed today. The mines are still empty. So what actually changed today? One thing: sentiment, feelings, emotions. That's it. Weak hands got scared and sold. Strong hands stayed calm and bought. Sentiment can flip on a dime. It flipped negative today. It can flip positive tomorrow. Now, look at the history of bull markets. What happens after a sharp crash? In a real bull market, a crash isn't the end. It's a reset button. It shakes out the tourists. It cleans out the leverage. It creates fear so the big sharks can come in and feed. They buy the fear. They accumulate at the bottom while retail investors are crying. Then the rally resumes stronger than before, faster than before. This has happened over and over again. The only question that matters is this: are we still in a bull market? Look at the evidence. Don't look at your feelings. Look at the numbers. Gold is still up huge for the year. Even after getting punched in the face today, silver is still up massive amounts. Central banks are buying more than ever. The dollar's long-term trend is still going down. Today was just a blip. Nothing suggests the party is over. Everything suggests this is just a halftime break. But I could be wrong. I know what you were thinking. Here he goes again. Another YouTube guy is telling me to hold the bag. Another guy saying, buy the dip while my account is bleeding. I get it. Seriously, you are tired. You are scared. You just watched your net worth drop by double digits in the time it took to eat lunch. The last thing you want to hear is some guy on the internet telling you to stay calm. But I'm not telling you what to do. I'm showing you the data. I'm showing you the patterns. I'm holding up a mirror to history. What you do with that information is your choice. I just want to make sure you aren't making that choice blindfolded. So, let's look at the future. There are 3 ways this plays out. Scenario 1, the bull continues. This crash is exactly like December. It's a fake out, a trap for the bears. February starts strong. We hit new highs by March. Silver breaks $150. Gold smashes through 6,000. I give this a 60% probability. Scenario 2, more pain. The Fed gets meaner. The dollar keeps flexing. China's economy gets worse. We see another leg down. Gold tests 4,800. Silver tests 90. I give this a 30% probability. Scenario 3, the chop zone. We go sideways. No highs, no lows, just boring, choppy, frustrating price action for weeks. Traders get bored. Retail investors quit. And then when nobody is watching, the move happens. I give this a 10% chance. But I promised you a specific prediction. I'm putting my reputation on the line here. I believe silver will be back above $120 by February 15th. Not March. Not someday. By February 15th. That is 17 days from now. Here is why I'm so confident. This crash knocked silver down from $121 to $108. That is a $13 discount. Do you really think the industrial buyers, the solar companies, the tech giants are going to ignore a sale like that? They have been waiting for a dip. They just got one. Think about it. We lost $13 off the price in 60 minutes. That feels like a catastrophe. But zoom out. Compare that to the rally we just enjoyed. It's a scratch on the paint of a rocket ship. The pattern from December says we bounce. The fundamentals say we bounce. The fact that everyone oversold in a panic says we bounce. And remember February 15th, that is the magic date. Why? Because by then the government shutdown drama will be over. The fear will evaporate. The buyers will come back from their hiding spots. $120. February 15th, write it down. Screenshot this. Hold me accountable. Which scenario do you think is going to play out? Are we going to the moon, or are we drilling to the center of the earth? Drop your answer in the comments. I read every single one. But knowing what happened is useless if you don't know what to do about it. Knowledge is power, but action is money. So here's the playbook. I'm going to give you specific orders based on your position. First, if you are holding physical gold and silver, if you have coins in a safe or bars in a vault, my advice is simple. Do absolutely nothing. Physical metal is not a stock. It is not a crypto coin you flip on your phone while sitting on the toilet. Physical metal is insurance. It is your life raft. It is wealth preservation. You don't cancel your car insurance because you had a bad day at work. You don't cash out your savings account because the stock market sneezed. You do not have a loss until you sell. Until you hand that metal to someone else, the drop is just a number on a screen. It's pixels. It isn't real. It doesn't change how many ounces you own. If you bought an ounce of silver at $100, you still own that ounce. The crash didn't break into your house and steal a piece of it. Ignore the noise. Turn off the news. Come back in 6 months. Come back in a year. The fundamentals, the reasons you bought in the first place, they haven't changed. Only the price tag changed. Now, group number 2, if you are trading with leverage, if you are borrowing money to bet big, today was your wake-up call, and it was a loud one. Leverage in a market this volatile isn't risky. It's a death sentence. Liquidations triggering liquidations. That phrase should haunt your nightmares because that is exactly how you go to zero. You think you are smart. You think you can handle the swings. You think your stop loss will save you. And then the price gaps down. It jumps right over your stop loss. You get liquidated at a price way worse than you planned and poof, your account is gone. This happens every single time there is a crash. The leverage traders get wiped out every single time. If you are using leverage on gold or silver right now, cut it. Reduce it. Kill it. The gains are not worth the risk of total annihilation. Group number 3, if you are sitting on the sidelines with cash, this might be the moment you have been waiting for. The best time to buy isn't when everyone is celebrating. It's when there is blood in the streets. It's when fear is thick in the air. When people are panicking, when the red candles are stacking up like Tetris blocks, that is when the smart money moves. That is when wealth transfers. It moves from the panic to the patient, from the fearful to the prepared. But, and this is a big but, only buy what you can afford to hold because I cannot promise this is the bottom. There might be more pain. There might be another drop. Buy in trenches. Don't throw all your money in at once. Buy a little now. If it drops more, buy a little more. Average your way in. And only use money you can lock away for months, not the money you need for rent next week. Now, for the last group, if you bought at the very top, if you bought silver at 121 or gold at 5,600, I'm not going to lie to you, that hurts. Watching your portfolio drop 11% in an hour feels like a punch in the gut. I understand that sick feeling in your stomach. But right now, you are standing at a fork in the road. You have 2 choices. Choice 1, you panic. You sell at the bottom. You lock in that loss forever. You make it permanent. You take your hard-earned money and you hand it to the guy who is buying from you right now. Choice 2, you hold. You grit your teeth. You accept that you bought at a bad time. But you realize that bad timing is not the same thing as a bad investment. If the house is still good, it doesn't matter if you bought it on a rainy day. History favors the patient. But you have to be able to survive the emotional roller coaster. You have to be able to look at the color red without freaking out. Can you do that? Only you know the answer. Let me give you some perspective to help you sleep tonight. In March 2020, the world fell apart. Gold crashed by 30%. People panicked. They sold everything. They said gold was dead. And what happened? By August, gold was at an all-time high. In 2008, silver crashed by 50%. Half its value is gone. Everyone said it was over. And then it went on one of the biggest runs in history. People swore silver would never recover. They wrote its obituary. And 3 years later, silver hit $50. Every single bull market has corrections. Every single one. It's like climbing a mountain. You have to stop and catch your breath. You might even slip a few feet, but you keep climbing. The question is not whether you will slip. You will. The question is, do you have the guts to hold on to the rope? That courage doesn't come from being brave. It comes from understanding. If you know why gold and silver are valuable in the long run, you can handle the pain in the short run. If you don't understand, if you are just guessing, every crash will shake you out. You will buy high when it feels safe, and you will sell low when it feels scary. That is a recipe for poverty. That is why I make these videos. I'm not here to tell you what to buy. I'm here to give you the map so you don't get lost in the woods. So, here's what I am watching like a hawk right now. For specific signals. Signal number 1, the DXY, the dollar. If that line keeps going up, prepare for more pain. If it rolls over and starts to fall, metals will bounce hard. Signal number 2, February 1st. That is the day after the government shutdown deadline. What happens in those first 48 hours of February will tell us everything. It's the starting gun. Signal number 3, China. Watch the news. If you see them printing money or stimulating their economy, that is rocket fuel for silver. But if you see more bad factory data, it's going to be bearish. Signal number 4, the Fed speakers. Listen to what they say this week. If they talk tough about inflation, hawkish, the dollar gets stronger. If they sound worried about the economy, dovish, the dollar gets weaker and metals rally. Watch those 4 things. They are your compass. Now, I know there are 3 types of people watching this video right now. Type 1 is the panicker. You are refreshing your portfolio every 5 minutes. You are sweating. You are thinking about selling everything just to stop the pain. You are letting fear drive the car. Type 2 is the statue. You are frozen. You don't know what to do, so you do nothing. You just stare at the screen and hope it magically gets better. Type 3 is the student. You are taking notes. You are figuring out why this happened. You are preparing for the next move. You know that a crash is just a sale for ready people. Which one are you? Be honest with yourself. Let me leave you with a brutal truth. Markets are a machine, and that machine has one job: to move money from the impatient to the patient, from the emotional to the rational, from the people who react to the people who prepare. Today, $6 trillion changed hands. It didn't vanish. It moved. Some people lost it. Other people gained it. Which side of the table are you sitting on? If you panic sell today, you hand your money to someone else. Someone who was waiting for you to break. Someone who understood the game better than you. But if you are still holding, you still have a chip and a chair. The game isn't over. And if you are sitting in cash, watching from the sidelines, pay attention. Opportunities like this are rare. December crashed, January pumped, January crashed, February is coming. The pattern is staring us in the face. Will it repeat? Drop your thoughts in the comments. I want to know what you think. I will be making a follow-up video on February 1st to see who was right. Do me a favor. If this video helped you calm down or understand the chaos, hit the like button. It helps the algorithm show this to other people who are panicking right now. And if you aren't subscribed, fix that. I don't sell hype. I don't sell opium. I show you reality. Share this with a friend who is freaking out. Send it to the guy who bought at the top. It might save him from making a huge mistake. Remember, 6 trillion gone in 60 minutes. If you bought at the top, thoughts and prayers. But thoughts and prayers don't pay the rent. Understanding does. Patience does. The crash happened. It's over. You can't change the past. No amount of wishing will bring those prices back. What you can control is your response. Will you panic and dig the hole deeper? Will you freeze? Or will you learn? The market doesn't care about your feelings. It doesn't care that you are scared. It only rewards the people who have a plan. If you didn't have a plan this morning, make one tonight. What will you do if we drop another 10%? What is your strategy if we rally 20%? Write it down, because there will be another crash and another rally. That is how the game is played. Always has been, always will be. Volatility is not an accident. It is the engine. It is how the market works. You cannot stop the waves. You can only learn to surf. I have spent years watching these charts. I have seen geniuses lose everything in a single afternoon. And I have seen average guys with no college degree retire rich. The difference wasn't IQ. It wasn't a fancy diploma on the wall. Smart people blow up their accounts every single day. The difference was ice in their veins. The difference was having a plan and sticking to it when the world felt like it was ending. Today was a test. The market held a mirror up to your face. It showed you who you really are. Did you flinch? Did you panic? Or did you stand your ground? $6 trillion changed addresses today. It didn't burn up. It flowed. It flowed from the scared to the prepared. That transfer happens every single day. The rich get richer because they buy the panic. The poor get poorer because they sell the fear. Next time, make sure you are on the receiving end of that transfer. But here's the problem. Knowing that you should buy the dip is easy. Knowing exactly when the dip is over is hard. If you buy too early, you catch a falling knife. If you buy too late, you miss the gains. There's a specific signal I use to find the exact bottom. It is a green light that flashes on the chart right before the reversal happens. 99% of traders miss it because they are looking at the wrong indicator. I broke down exactly how to spot this signal in this video. It is the difference between gambling and investing. Click here. Let's find the bottom.